Hello, this is the Chartprofit webcast. 1 hour 30 minutes into the trading day on Friday 29th of May. This from the pre-open today. Haven't marked any aggressive reactive buying or selling for 6 days here. Market's been waiting for something. Probably the jobs data was released earlier today, and market's been hoping for a resolution to the Greek crisis, which is ongoing. So we've been consolidating in a range, albeit a higher range than previously, centered around 2107, which was for a brief period the 10-month point of control. As I said today, that's migrated lower down to this level, 2098.50, just above where it was previously. So that is the level we now monitor. Price relative to that level should give us an idea of strength or weakness, and I've said here bulls would hope that the E-mini recovers this level as quickly as possible. A price below 2098.50's weak price location. So let's have a look at the real-time chart. This is a 5-minute on the E-mini. We opened here. Here's the 2098.50 point of control. There was a little sell-off here down to this new low, 2083, and we've seen a rally back up to probe that level, which is obviously now resistance, and that is the level we need to see recovered. The E-mini printing back above here puts it back in a stronger price location. So just zooming out to a daily chart, that's where we are currently. We know from experience when the market gets fearful, we'll see price quickly back at the most local point of control, which now is this level. So that's where we are currently, actually just below that. So price relative to this level, most important into the coming week. I said pre-open that breadth had deteriorated. If you look at the breadth indicators here on the New York chart, you can see on the right hand side here they're all printing below the levels that indicate a healthy market or otherwise. So definitely want to see an improvement in breadth. Interesting that the NASDAQ indicators actually look a little healthier, as you can see here quite clearly, and actually the Russell 2000 as well look more healthy than the New York chart. This is the S&P 500 pulse chart. The price oscillator at the bottom here actually still above zero. We're dipping a little bit, but we're still above zero, which is okay. The breadth, as we've just seen, could well do with improving. But the chart itself holding above 207.92, which is the big support on this chart. Price down here would not be good. So here's the current chart with today's bar here. You can see we've recovered a bit, actually now slightly up on the day. If you just look at price action from mid-May, it's generally been like this. Whereas on the Russell 2000 ETF since mid-May, it's generally been sort of like this. So the small cap's relatively stronger at the moment. Interesting on this chart, the 7-month point of control or time level has migrated slightly higher to 124.50, and this will now be the level that we will use to gauge strength and weakness, and we're currently printing just a little bit below that. If we see the Russell recovering back above here, that would be an indication of strength for the market. All sorts of indications currently are very mixed. Hopefully we'll see things clear very soon one way or the other. There's been a general kind of consolidation and tightening of the patterns. This usually leads to boredom and then breakout, so let's not take our eyes off the charts. Large cap diamonds currently printing below its 12-month point of control in a weak price location. Again, you can see the difference between the large caps and the small caps from here. And this is a relatively strong chart. This is the financial sector, XLF, and you can see again from mid-May we're higher, and we're currently holding above the major point of control, which is at 24.25. So this is a leading chart. You can see today's price performance as well, pretty strong. I've just converted there to a monthly chart to give you the price action all the way back to 2007 high over here to the 2009 low. Here's the halfway point. Strong price location above that and now above this point of control. And here on the weekly, looking at that major halfway point, you can see here and here there was a little probe, but we've held that level, and that's a pretty good strong pattern So I'm thinking this is an interesting chart, one of the key charts going into next week. Quick review of other charts. This is the Nikkei. A little weakness this week, but not much. Still a strong looking chart. The 9-month point of control on the DAX is at 11,790 up here, and we are currently printing in a weak price location below that level. Just a little test here of the May low. FTSE 100 is an interesting chart, level that we've been watching for a while. 68.34 is a big level on this chart. We saw a test here, and we're currently at the end of this week printing below that level here. So going into next week, I'd really want to see the FTSE 100 back above 68.34 up here. This is weak price location currently, so more price action down here would be indication of further weakness. In the supporting charts, looking here at TLT, the T-bond ETF, 117 is 117.14 is the level we've been following for more than a few months, many months, probably back well over a year. That's our major point of control, and interestingly, we've sold all the way down to that level, and it has stalled. As you know, the acceleration started here when the 6-month point of control migrated to this level, and we saw this pattern. So this is kind of normal price action. We've got weakness here, and then we see the next major level of support come into play. So right now there's the interesting possibility of this support holding. We'll see going into next week. Certainly don't want to see price down here. And one clue here is the 7 to 10 IEF, which is currently printing below its major point of control, which is at 105 dead in here. One of the dilemmas that currently seeing a lot of attention being paid to is where do investors go? The usual safe havens aren't looking particularly safe right now. You see that reflected in the charts here. So bonds look pretty weak. Equities kind of undecided at the moment. Asia looks pretty good. Europe not so strong, could recover. US relatively holding up, could look strong with a little more upside action next week. Currently these bond charts don't look too good. I think you know what I think of the precious metal charts. Still very weak looking charts to me. Here's the 18-month point of control. So it's just been really a series of weak responses this year. We saw the probe above the major up here, and then from these two levels we had the halfway point off the November low, which came in here, and this kind of price action was not convincing, and we're back below the 18-month now down here. So as I said last week, you could easily see a test of these lows, and I think we probably will. SLV, the silver ETF, again this probe here into the 18-month, and we've seen weakness this week. Also, this is DBC, the commodity ETF, 18-month point of control at 18 exact. This is a pretty weak price pattern, a lower high below that point of control. So again, not a strong chart. But the oil chart, looking here at USO, oil fund ETF, as long as that holds above the 16-month point of control at 1839, this is all pretty good consolidation in a strong price location. So this is a better looking chart. Price back below that level would very quickly reverse that situation. Again, we'll likely see a test of the March low. So how is the dollar faring? This is the dollar index. We've been looking at this level for a while now, a good few weeks, 94.67. The 12-month point of control migrated to that level. We saw price action above that level, which was encouraging last week, and then we've sold off this week to the exact point here of support. And today we're running reasonably strongly. So I've just drawn in the halfway point from here to here, and the next level of interest is just about the high of the day today. So price back up here, we'll monitor this in the pre-open, but price consolidating back above that level would put the dollar back into short-term strong price location. But this is encouraging, this support that we've seen right there. Dollar doesn't want to give up at the moment. Another level we've been watching back in play. This is truly the major point of control at spot 76 on the Aussie dollar, and we keep showing you this. The price has been supported at that level 3 times, and we're back at it again here. This would be a big clue re the US dollar strength. We see price falling down here, put this chart in a really weak price location and possibly launch another leg up in the dollar index, in the dollar itself. The pound against the dollar made its low here in April, an impressive rally. Price action since then, coming into May, these two levels of overhead resistance have basically turned it back down. In the longer time frame, it's a pretty weak looking chart still. An interestingly different time frame, but a level of importance, a half range off the April low. And again, we'll monitor this. If we see price back below there, that would indicate weakness here. So we could see this going into next week where both this chart and the Aussie dollar move weaker. We might not. We need to monitor these charts. And from my way of looking at things, the euro as well, still unconvinced. 12-month point of control is the first level of resistance that we need to see this chart overcome to put it back in any kind of strength. And currently we've tried, what, 3 times over the last month, not managed it yet. So again, we either see that happen, so this would put it in a stronger position, and here's the halfway point off the low. Price here would again indicate a break of that low. Just wondering if we'll see sort of some kind of resolution here and directional move for these charts, with a big clue next week on these levels. The dollar yen pretty convincing, out on a new high here for this move. To finish, I just want to review the sentiment indicators. This is my version of the Ridex assets ratio. It's moved very little this week, away from the level around 11, so it's quite a bit lower than its peak earlier in the year, up above 14, and the recent lows. This was a multi-month low in the ratio recently, up around here, but we haven't seen much from the S&P itself at the moment. I'm not really making much sense there. Let's try and explain. Talking about the bear fund assets that I follow, really very low indeed, close to the extreme low down here, just a little lower. So this is a worry. Very little assets in the bear funds, indicates the retail investor very complacent about the possibility of a sell-off. Always a problem. Be much better if we saw these spike up. I suppose the good news, as I've mentioned before, is that the bull fund assets that I follow are also well down from the peak late last year up here. Public poll from AAII, the bulls percent was almost unchanged, 27.3. 2 weeks ago, the bulls percent was 25.2. That was a 2-year low. That was pretty encouraging for the market. 2-year low in the bulls percentage for the public. And you can see the 4-week moving average of net bulls minus bears in yellow. It's been falling pretty consistently all year. Almost same as the Investors Intelligence poll. Since late February, the 4-week moving average of net has been falling. 3 weeks ago, the bulls percentage here at this point reached a 6-month low. Not too much of an indication, and we'll get that. The two big indications I could see on this chart: the possibility of this level being broken by the 4-week moving average, which would be lowest expectation for equities since late last year. The other level we need to watch, of course, is the high point here. Looking at active money managers, current equity exposure in the exposure index, a little higher again this week at 71. 3 weeks ago here, the index reached a 6-month low. Again, that would usually be taken as a pretty positive sign for the market. But as I've just said, not much to talk about here, this consolidation. Lipper US fund flows, a reported equity fund including ETF inflows of 6.2 billion in the week to Wednesday. That's actually the largest single weekly inflow in 10 weeks. It lifts the 4-week flow back above zero for the first time in a few weeks. But currently it's not high or low enough to give us any kind of indication, as in this is too high and this is too low. Much more useful on the extremes, and this 4-week flow been much more useful for buy points in this bull market when it's been breaking down here to new lows, as you can see here. Back in the category of reasons to be fearful, we're looking at the margin debt. Reported for April, the latest data shows the margin debt increased by a huge 6.5% in April, is now above 500 billion for the first time. up here as a sentiment indicator. That's probably quite worrying. Just finish with some time charts. This shows the current area of the decennial cycle, i.e. June for the Dow in the 5-year. We're in 2015, and the above chart shows you the last 9 decades for May. I beg your pardon, for June in the 5-year. All of those charts were based to 100. 6 of the previous decades finished above the point where they started in June, 3 below. If I average that chart out and rebase it, it looks like this. We're currently about here in the chart, so it's a calendar chart. That will be next week, and if we follow the decennial pattern down to this kind of micro level, we should be expecting a decent enough June. Price itself much more important, and all of that conditional on some improvement, as we discussed earlier. For instance, the E-mini printing back above 2098.50 back here. Okay, that concludes. Once again, I wish you a good weekend, and thank you for watching.